I'm going to try to do a fast version because we're behind schedule a bit, but so I'm not going to really talk about or focus on an individual company, but more the general thematic of electric vehicles and implications for the mining and metals industry. And in my opinion, this is the single most important development in the mining industry since perhaps the start of the super cycle in the early 2000s. So a lot of the discussion is going to be what are the driving forces, and I think after the discussion, I suspect you'll agree with me that it's not a question of if the electric revolution is coming, it's just a question of how fast the adoption rate will be. And so let's start with just a general discussion of some of the drivers. And the first is really government regulations. And I put on this chart just one emission standard that is mandated by various jurisdictions. In this case, it's the EU, the US, Japan, and China. So this sort of represents the majority of passenger vehicle sales in the world today. And this is just one metric. This happens to be grams of carbon dioxide per kilometer traveled. There are a bunch of other metrics, but they all have the same unmistakable pattern, which is increasingly stringent, lowering emission standards. And the only way that a vehicle manufacturer, this happens to be out through 2025, if the chart went further, you would see the lines continuing to go down. And increasingly, the only way an automaker can meet these mandates in these various jurisdictions is by dialing in more zero-emission vehicles into their sales mix. So this is just one aspect from the driver being increasing regulations. There are some outright mandates. So for example, California mandated last year that come 2025, 25% of every manufacturer's vehicles that are sold in the California market must be zero emission. So one in four vehicles sold in California starting 2025 have to be zero emission. And it was interesting this morning, I saw a press bit that GM came out yesterday, the CEO, and called for the federal government to adopt the California mandate for the entire US. That is, by 2025, one in four vehicles, if you're a manufacturer, must be zero emission. And GM's stated incentive for doing that is that it will speed the entire auto industry, at least in the US, toward a faster transition to the inevitable, which is electrification. You know, GM doesn't do anything without some degree of self-interest, and the self-interest is they have, rightly or wrongly, some confidence that they're further along in the electrification of vehicles than maybe some of their competitors, like Ford, for example. So this is a significant driver in this electrification trend. Perhaps even a more compelling driver is raw economics and from the consumer standpoint. So batteries are improving, at least since 2012, at the rate of 15% year on year. And if you take that trend line and you project it forward, in the not too distant future, you're going to have a crossover point where it's actually cheaper for the consumer to purchase and operate an electric vehicle compared with an internal combustion engine, ICE, as they say in the business, equivalent. And it's rather staggering when you look at the numbers. I stole this chart from Vale, but Vale stole it from Bank of America. So, you know, behind every great idea is a felony, and this is a testament to that. So, by 2021, at the current pace of battery development, if you're in the European Union, it will be cheaper to purchase and operate an electric vehicle than the equivalent diesel unit. A year later, the same will apply to a petrol unit in the EU, and a year or so after that, the US and China will fall in line. Once you hit these crossover points, in my view, it's kind of game over for the internal combustion engine, because at that point, what rational consumer would pay more for a technology that is evidently and obvious to all is obsolete and going the way of sort of the buggy and the buggy whip. So this is pretty compelling, and at this point you'll have a tipping point. It's a little bit like smartphones. You know, you have the early adopters, and at one point when smartphones first came out, sort of 10% of the population had smartphones, and then there was a tipping point, and 18 months later, 80% of the population had smartphones. So it will be an S-curve, classic sort of adoption rate. It'll start slowly, and then it will accelerate. There'll be a tipping point, and at that point everybody will be thinking first and foremost of an electric vehicle. Why would you ever buy an ICE again? Because it's outdated technology, and it's not cool. So this is perhaps maybe the most compelling driver for this transition to electrification. There's a third driver, which is also economic, and it's from the perspective of the automaker. It turns out that electric vehicles are actually cheaper and faster to build than ICE equivalents, simply for the reason that there are so many fewer moving parts and parts in general. So the average electric vehicle has a third the parts of an equivalent ICE. So for an automaker, for a new factory, the cost of the footprint of that factory is about half what it would be for a conventional factory. The capital cost is half, and baked in to the numbers is about an intrinsic 1/3 improvement in labor productivity, just because the number of labor hours needed to put together the subcomponents and components of an electric vehicle are so much less. So these are three rather compelling inducements for the transition of the entire supply chain and consumers from internal combustion engines to electric vehicles. So what does that mean? It means electric vehicles are going to be adopted at an accelerating pace. So here are some interesting numbers. The first circle are electric vehicle sales out of total passenger vehicle sales. The passenger vehicle market is on the order of 85 million units a year. So last year electric vehicles comprised about 1% of new passenger vehicle sales. This year, which is almost done, the number will be 2%. Okay, so it's still a 100% gain, but the trend will accelerate, being driven by government mandates, improving battery performance, and the fact that automakers now are on the trend, and they realize that if they're laggards in the electrical vehicle transformation, they're going to end up being the high-cost producer in the dinosaur. So the sort of consensus view is that by 2025, something on the order of 15% of new passenger vehicles will be in the form of electric vehicles, could be as high as 20%. And by 2035, it's sort of game over for ICEs. At that point, the majority of passenger vehicle sales will be in the form of electric vehicles. And you see this happening now. So for example, Volkswagen announced earlier this year that they expect by 2025, which is not that far away, it's 7 years, that 30% of their sales will be electric vehicles. And they're now in the process of retooling their entire supply chain to deliver roughly 1/3 of new vehicles in 2025 in the form of electric vehicles. GM has announced that it expects that 40% of vehicle sales for the case of General Motors by 2030 will be electric, and Ford separately announced that, who's considered to be sort of the furthest behind on the electrification trend, that by 2035 they expect the majority of their vehicle sales will be electric. And you can also see it happening, for example, in Norway. Last year, 60% of new vehicle sales were electric. So think about that, already in Norway. Now, Norway is not representative of the rest of the world, but it's pretty interesting that last year, 60% of new passenger vehicle sales in Norway were electric, and Norway is projecting by 2025 that it will be 100%. So this sort of massive adoption has significant implications for the metals mining industry, particularly for those metals that are involved in the fabrication of batteries, namely lithium, cobalt, nickel, and copper. So let's take a look at the metals. This chart, which again I stole from Vale, who stole it from, I think, Citibank, has aluminum. I'm not going to talk about aluminum. Aluminum is involved in one battery chemistry, which is NCA, which is only used at the moment by Tesla and Panasonic. But instead I'm going to substitute copper, which is not used specifically in batteries, but these new cars require, as I'll talk about later, a lot more copper than conventional vehicles. So let's start with lithium to give you some numbers, and I think this will illustrate how dramatic the impact will be on incremental demand for these selected metals. So lithium is kind of a niche market, 225,000 tons a year. That's about, to put that in perspective, that's about 1% the size of the copper market volumetrically. But if you look at the chart on the lower left, you'll see in the fourth column, LCE, that's lithium carbonate, the amount of lithium carbonate that's consumed by various vehicle types. And if you look, just to pick one, you look at the Tesla Model S, that's the 70 kilowatt hour battery pack, which is not the top of the line, so there's a bigger one, that consumes 63 kilograms of lithium per unit. If you take a reasonable assumption in terms of mix of battery chemistries, because there is a mix of battery chemistries, there's NMC, there's LIF, there's NCA, and also a reasonable mix of vehicle types, and you say, okay, how much lithium does the world need if the vehicle penetration rate is 15%? The answer is it needs almost 4 times current mine supply. And the projection is that we'll be at a 15% vehicle penetration rate for electric by 2025. So that's kind of interesting, because that means that the industry over the next 7 years is going to have to increase mine supply 4x, 400%. I remember reading an analyst report that said the mining industry hasn't seen that sort of incremental demand since the introduction of tin foil in the early 1900s and its impact on aluminum. And this, by the way, is a long lead time metal for new supply. So half of the world's lithium comes from brine, half from hard rock. For brines, the lead time for a new mine is 7 years, which is about the time when the market will need it. That's assuming everything goes well, and of course it's the mining business, so it never does. And hard rock is 3 to 5 years. So our thesis is that shortages will emerge as these EV offerings ramp up and proliferate, and if you're an investor, you want to have lithium exposure. You certainly don't want to be, even if you're somewhat skeptical, you don't want to be short lithium, because shortages will emerge in the supply chain. There'll be spikes in the price, and all the lithium sector participants, whether they're explorers or developers or producers, are going to get an uplift. It's sort of the same story with cobalt. If you run, let me just mention, so if you assume that that market penetration for electric vehicles is 25%, it means the world needs 6 times current mine supply. If, just for sort of a thought exercise, if you say, okay, what if tomorrow somebody hit a switch and every new vehicle was electric? The world needs 25 times current mine supply. And this is in an industry that typically grows in line with world GDP growth, so 2, 3, maybe 4% a year. And now you're talking about growth rates which are sort of 30% compounded year on year. And so it's an interesting place to be. Cobalt, you need cobalt in all of these battery chemistries, not so much for energy density, but you need it to stabilize the lithium. Lithium is the lightest, highest energy density metal known to mankind, which is why it's used for battery manufacturing. It cannot store a lot of energy, and it's very lightweight, but it also happens to be most reactive. And to stabilize the lithium in the electrolyte, you need cobalt, and at the moment there's no substitute. And that's what happened with Samsung with their exploding phones. Samsung tried to push the margin, they upped the voltage, and on the Galaxy 7, I think it was, that model, and they lowered the cobalt and started shipping the units, and they started to explode. So there's no substitute. So the same sort of numbers, if you assume 25% penetration rate, the world needs 4 times current cobalt mine supply. But this is particularly interesting, cobalt, because there, with one exception, there is no such thing as a cobalt mine. It does not exist. Cobalt is produced strictly as a minor byproduct of certain copper deposits in Zambia and the Congo, and elsewhere in the world as a byproduct, a minor byproduct of certain nickel projects. So in order to ramp up supply, it's not like lithium or nickel or copper where you can go ahead and start up a new mine. If you want more cobalt, you're going to have to produce more nickel or more copper, and the only way a miner is going to produce more nickel or copper is if there's a higher incentive price for nickel or copper, because cobalt typically represents less than 5% of the revenue stream of that mine. So this makes cobalt particularly interesting for an investor because it's so supply challenged. Also, 65% of the world's cobalt comes from the Congo. So that's kind of interesting, because Congo is not perhaps the most politically stable. So if something goes wrong in the Congo, guess what? There's no cobalt, and prices will spike. Cobalt is highly price inelastic. It only represents 1 or 2% of the cost of the vehicle. So if a battery manufacturer or a vehicle manufacturer needs to pay 10 times last month's cobalt price to get cobalt, they will, and it won't destroy demand. So cobalt is a particularly interesting metal, both because of its mouth-watering demand growth, but also the fact that it's supply challenged, being a byproduct and being largely sourced from the Congo.
Mike, excuse me.
Yeah.
Is it 1% of the cost of the battery or the vehicle?
Vehicle. Okay. Yeah. It's on average, like the Tesla Model S, let's say the 70 kilowatt version is 1.7%.
Thank you.
Yeah.
So Mike, I assume your take, all this talk about taking the cobalt out of the batteries. I mean, Tesla's been one that's been a bit vocal about that. You just don't believe it's going to happen.
No, and Tesla's been able to reduce it significantly only because of their unique chemistry. So they use a chemistry NCA, and they're the only manufacturer, automaker that uses NCA, and the NCA battery chemistry intrinsically has about 40% the required cobalt of what is becoming the dominant battery chemistry, which is NMC. And everybody is desperately, all the battery guys are the cathode makers, like BASF and Ganfeng and Tingji. These are the principal sort of cathode makers, and that's the principal component in these batteries. And they have been laboring away for years to try to reduce or substitute out the cobalt with no success.
And by NMC, you mean nickel, manganese, cobalt?
Yeah, exactly. And that's emerging as the dominant chemistry. And again, the Tesla are able to reduce, not eliminate, but reduce the cobalt required because they're using NCA, and intrinsically that chemistry needs less cobalt to stabilize the electrolyte. But the rest of the industry is going NMC, and right now there's nothing in sight in terms of revised chemistries or packaging or power management systems to reduce the cobalt. And everybody, look, I go to a lot of these sort of battery chemistry conferences, and I went to one recently in California, which was, it doesn't sound so interesting, it was the cathode producers conference. But it actually is interesting because half the talks are about battery chemistry and cobalt reduction. And nobody sees a path to reducing substantially the amount of cobalt, and the fear is everybody remembers what happened to Samsung when they tried to dial back the cobalt. And as has been said in private by more than one participant at the conference, the last thing an auto manufacturer wants to see on YouTube is the minivan exploding with mom, dad, and 4 kids. Not good. So yeah.
Sorry. What percentage of the global market does Tesla own in batteries now? You know, NMC versus...
At the moment, Tesla is about 18% of the battery market, specifically for mobile applications, meaning electric vehicles.
Thank you.
You're welcome.
Are your slides on a website?
No, but I think maybe Eric or Erica, would they be available? Otherwise, you can email me and I'm happy to send them to you.
I'm happy to send it to you.
Erica has them, so she can shoot them to you. So cobalt's particularly interesting, and I'll explain how we play that as an investor. Nickel is sort of you can argue, okay, lithium and cobalt, they're kind of niche metals, and okay, they're a little sandbox, but here now we're moving into sort of bigger base metals. So nickel is a 2.1 million ton a year market. That's, just to put it in context, that's 20 times the size of the cobalt market and 10 times the size of the lithium market. It's still a dwarf compared to copper, so it's about 10% of the copper market. But nickel is particularly interesting because you get the energy density in a battery chemistry from the nickel. So what's happening at the moment, the cathode guys are focusing on, number one, trying to reduce cobalt, no success. Number two, trying to up the energy density, and the way they do that is they just keep trying to pack more nickel units in. Now, nickel is particularly interesting. We always look first at sort of the macro, which is why we've spent so much time on the electric vehicles before we decide what metals to go after in what projects. So nickel has an interesting history. Nickel at the moment is trading at $12,000 a ton. It peaked in 2007 at $50,000 a ton. And it went up a little too hard and fast, as often is the case, and it induced some innovation, particularly by the Chinese, and the introduction of something called nickel pig iron, which was sort of a cheap way to get nickel units into steel, and it killed the nickel market for the next 11 years. So the nickel market's been kind of on its back since it peaked in 2007 because of NPI. Now, the interesting thing is the nickel market is bifurcating. Nickel, people say the nickel market's 2.1 million tons, that's true, but really the nickel market is two markets. You have class 1 nickel, which is nickel sulfate, which is suitable for battery manufacturing. And you have class 2 nickel, which is the other half of the market, which has ferrous units, most of it coming from nickel pig iron, NPI, and that is not suitable for battery manufacturing. So really, the nickel market, and this will become important as I go through a couple slides to explain the nickel story, this is probably the most exciting play, nickel, for the next sort of 3 to 4 years, and I'll explain why. So really we're talking about a base load of class 1 nickel of 1.1 million tons. So since 2007, the story in nickel has, nobody's built a new big nickel mine because the incentive price wasn't there. Nickel, by the way, is the most capital intensive metal in terms of bringing new capacity on, especially for HPAL, which is becoming the dominant sort of process route for producing nickel. And it's been, and finally, because nobody's built any new nickel mines for 10 years, deficits started in 2016 and are gradually working over a huge sort of inventory overhang, which will be done in sort of in the next 2 years or so. And during that time period, we expect a major re-rating in nickel price because everybody in the industry, particularly the battery side and the metal side, sees what's happening, that there's a massive structural deficit that's been built in to the nickel industry because nobody's built a new mine in 10 years, and all of a sudden, out of the blue, you've got this new incremental demand from electric vehicles that nobody ever dialed into their numbers because historically and until today, the nickel market is all about stainless steel. 75% of nickel production goes into stainless steel. So it's been kind of a boring stainless steel. It kind of grows with stainless steel. Stainless steel grows in line with world GDP growth, and everybody yawns. Well, all of a sudden, those of us in the industry are waking up to the fact that what's going to happen very soon is what you see on this chart. Because of these structural deficits, there will be an absolute deficit emerging in 2021, 2022. Nickel prices will skyrocket, and the average lead time for a new nickel mine, particularly HPAL, is, pick a number, it's anywhere from 6 to 10 years. Can be longer because they're so problematic and complicated and capital intensive. And so it's going to take a while for supply to catch up. And still today, nobody's building new nickel mines because the incentive price for even thinking about pushing the button on a capex for a nickel mine is probably on the order of $30,000 a ton, and the market today is $11,800 a ton. But there will be a day of reckoning, there always is, and nickel will skyrocket as it did because of electric vehicle demand overlaid on the market. And here's a chart. Again, I stole it from Vale, who took it from somebody else, but Vale is the world's largest nickel producer. It's produced slightly more than the number 2, Norilsk. And here's their chart, and they have a group of 15 people in Toronto that do nothing but think about this all day, since they're the largest producer of nickel. So in the conservative case, which is the electric vehicle penetration rate only being 10% by 2025, the market goes into physical deficit with no above ground inventories. In 2023, in the more upside case where penetration is more in the order of 18% by 2025, the deficits emerge in 2021, 2022. So nickel is poised. Nickel is not a story for today, but you want to think about getting yourself set as an investor over the next couple of years, and then just stick it in the drawer and wait for the fireworks, and they will come, and you won't be disappointed. The last metal I'm going to talk about, which is impacted, is copper. And the copper story is a little bit like nickel. It's not a story for today, but it's kind of coming. The copper price has been depressed since 2012, and so nobody's been building new copper mines for the last 6 or 7 years. So there's a structural deficit baked in. And again, these are large CapEx projects that once you decide to build something, it really doesn't come on till 3, 4, 5, 6 years later, assuming you've got a feasibility study and preliminary engineering already done. If you don't, it's even longer. So this is interesting because the table at the very bottom here, and let's just look at the base case. So the average electric vehicle needs 83 kilograms of copper. By the way, that's compared to 20 kilograms of copper for a conventional ICE vehicle. So just base case, it needs 4 times the amount of copper. But for every electric vehicle that's sold into the market, it needs to be charged. And you can do the calculation of how much the power grid's going to have to expand to charge those incremental units. And the number turns out to be about 20 kilograms per vehicle in power grid infrastructure is required for every vehicle. And then we're not done, because you actually need the charging infrastructure where you actually plug in, and that's about 6 kilograms. So in total, an electric vehicle creates an incremental demand for about 110 kilograms of copper. That's 5.5 times the equivalent for an internal combustion engine. And copper is it's by far the biggest base metal. It's 23 million tons a year. But this is, and the copper industry is having enough trouble keeping up with base load demand. Now what you're dialing in a demand that didn't exist before. So what does that look like? It looks like in a case where 30% of the market is electric vehicles, and we're not too far from that, the world's going to need 5.5 million tons of incremental copper. That's equivalent to about 20%, just less than 20% of today's total world copper mine supply. And that doesn't take into consideration that most major copper mines have declining grades, depleting resources, and on top of this you have to add world GDP growth. So again, copper is a story not for today, but it's coming, and it's good to be positioned. You want to get positioned actually before things start to move, and not after, providing you're patient. So those are sort of some of the metrics and anticipated impact on these metals. So as an investor, I tend to prefer the higher risk reward. So this is health warning. This is how I've played it, and you'll see in a moment it hasn't worked out too well. But I prefer to be early than late, and I'm patient. So when I buy into a thesis, I stick it in the desk drawer, and I don't worry about it. And I only change my mind if I change my mind about the thesis. So for lithium, I'll show you the chart, and then I'll come back. Not a pretty chart. I bought in at the top, the IPO, at $1.30 last year. This is a company. Now, why did I buy this company? Well,
wait, real quick. Sorry.
Before
you get into the top picks, can you just tell people about how this strategy worked for you with uranium back in the 2000s? Give a little example about what you did and how it paid off.
Sure. So my partner and I, a guy named Stephen Titels, we've always kind of followed the same MO in terms of investment. We try to get comfortable first with the macro story, so we look and have to get convinced that the macro story is there. And that's why we've spent all this time, the last 2.5 years, delving into the whole sort of electric vehicle thematic. Because we've done it the other way, and honestly, unless you've got a wind at your back in terms of a rising underlying commodity price, it's just too hard. So once we get the macro and get comfortable that this is a metal and we think it's going to go up and substantially, and these are the reasons why, then we don't like exploration risks, so we search sort of the world for assets that have been drilled out, that are large, and in most cases have something wrong with them. They they are low grade, or they're in a bad neighborhood like the Congo. And once we get comfortable with that, if the entry price is right, we'll take the asset in. So this has worked very well in certain instances. In many other instances, has been an utter wipeout, because either we couldn't find the asset, or it turns out we found the asset, but we got the macro wrong. And but when it works really well. And Eric's referring to one of our best transactions, maybe our best. We got interested in uranium in 2005. The uranium price was we did a year of work in 2014, getting comfortable with the supply-demand outlook and the dynamics. And we said, okay, look, uranium's going to go up. There's no question about it at the time. Uranium price was $14 or $15. We scoured the world for, we don't like exploration risk. We found a massive low-grade deposit in Namibia, West Africa, called Trikopi, which had been drilled out by Total in the 1970s and then abandoned when uranium prices collapsed. We bought it for $4 million. People laughed at us because it was such low grade. It would only work if uranium price went to 50, and nobody thought uranium price was going to go to 50. And instead, the uranium price went to $150. Within 2 years of acquiring that asset for $4 million, we sold it for $2.5 billion to Ariba, cash. And here's the most amazing part of the story. We never put a drill hole in it. We did no work on it. The only thing we did, Stephen and I, was one day we had time, we drove out there and we walked the ground. Just to feel better, like we had done due diligence. And as my partner is so fond of saying, you know, Mike, it's always bad luck to walk the ground prior to buying it. You buy it and then you go and you visit it. It's better luck. Well, it was good luck. So we went from some $4 million to $2.5 billion in less than 2 years, cash, and we didn't do anything. So why did it work? It worked because, one, we were lucky. Our macro view was correct. The uranium price was going to go up. And when you have a rapidly rising underlying commodity price, something that goes up 3, 4, 5, 10x, and some of these metals have that potential, particularly lithium, cobalt, then size matters more than grade, because then all the industry players are looking for assets, they're looking for resources, and they pull out the top 10 resources in terms of size, and they focus on those. And they don't worry about grade, because if the underlying commodity price has gone up 3x, then what was low grade when you bought it, all of a sudden, you know, has a payback period of less than a year. And that was the case in Trikopi. It had a payback period of less than a year, even though it had a capex of $1 billion. Even though when we bought it, 23 months earlier, it was uneconomic. And the only thing changed was the uranium price, and the reason we were successful, right place, right time, and it was a massive resource. So that's always been it. And so when I talk about some of these picks, I'm picking them largely because of massive resource.
So Mike, maybe like a minute on each pick, spend 2 on Giga, we're waiting on lunch, and everybody for the Q&A, you're going to be at lunch, Mike, right?
Yeah, I'll be at lunch for sure.
Try to talk with him at lunch, and even a little bit after that, he'll be around for any Q&A, so just so we can wrap up.
I'm just going to spend not even a minute. So LSC Lithium, largest lithium resource package in the lithium triangle, where the brine, the low-cost stuff, comes from. And unfortunately, this is the chart I continue to buy, averaging down. So the market cap is $57 million today. There's been $150 million spent, and I wish I was buying more of it now instead of when I bought it, but I'm not that fussed. It's in the top drawer. The lithium story has not played out yet, because electric vehicles are still only at 2%, but watch this space when electric vehicles in 5-6 years go to 10 and 15% of the market, and everybody's screaming for lithium. And this will be on top of everybody's list because of its massive footprint in terms of size. It owns more lithium brine acreage than all the other players in Argentina, including FMC, combined. This nickel, actually the man is sitting there, Mark Jarvis, the CEO. This is our favorite play. This reminds us of uranium and tricopy. We bought in, and I'm a major shareholder. I think I'm maybe the second largest shareholder, and my colleague is also the second or third, and Mark may be the first. But this is an unbelievable story. It has a market cap of $8 million. It was 9 when I put the slide together. It's actually gone down. Oh, this is the chart on it. Another disaster. I bought in here, and I've been averaging down. So they have $8 million market cap, $6 million in cash, but the interesting thing is they own the world's second largest undeveloped nickel sulfide deposit. Let me repeat that, the world's second largest undeveloped nickel sulfide deposit. Nickel sulfide is the good stuff, it's the class 1 stuff that the battery guys need. This is in a good jurisdiction, British Columbia. It's not in the Congo. And it's, in our opinion, it's massively mispriced because it's an orphan, it's an outlier, there's no research. The only way you can find out about it is talk to Mark Jarvis behind you. There's been no promotion. In the last nickel boom, this same asset had a market cap of $180 million. So we're happy to just keep buying it, putting it in the drawer, and it will go when nickel goes. It reminds us so much of our uranium play. Copper, Nevada Copper, I'm not going to talk about that. I own Nevada Copper. I understand Matt Gill was here yesterday and gave a talk. I like it because I like copper. I also own First Quantum. You know, that's kind of my large cap copper exposure, but for the smaller cap, I own these guys because they're in construction and they'll be producing late next year, and it's in North America and all that other stuff. And again, I bought some more last week because I started buying when it was 78 cents, and I picked up some more last week because it keeps getting cheaper, and eventually it will come good, so I'm not worried. I'm not going to talk about grid because we don't have time. I will mention on cobalt. Cobalt's interesting because of the supply challenge, and so how do we play that? Well, what we did was, since there is no such thing as a cobalt mine, starting 2.5 years ago, which is myself, a guy named Anthony Maluski, Stephen Dettels, and Paula out of Switzerland, started buying physical cobalt. So we bought what today is about $180 million of physical cobalt, just privately. As a group, we bought it. We stuck it in a warehouse in Rotterdam, and we thought, okay, then other people started coming to us and saying, could you buy cobalt for us? And we said, well, we're really not in that business, and we just bought it for ourselves. We actually own the world's second largest stockpile of physical cobalt. The only bigger stockpile is the Chinese Strategic Reserve, and they don't have much more than we have, and we may eclipse them. And then we came up with the idea of, okay, hey, why don't we list this? So we listed the company. At the time, it only had $200 million of physical cobalt on the Toronto Stock Exchange. We raised this was last year, we raised $800 million. We have deployed most of the $800 million by buying cobalt from Vale and from Ramu, Highland Pacific. A substantial amount of cobalt we paid up front for the next 35 years. So for the next 35 years, Cobalt 25 every quarter receives a big chunk of cobalt that goes into our warehouse. So it's a pure cobalt. The ticker is KBLT. It's cobalt 27. 27 is the atomic number for cobalt. That's where that number came from. And it's as simple a story as it can be. It's pure cobalt. It has $200 million of cobalt in the warehouse. It has 35 years of cobalt supply being delivered by 2 existing producers quarterly. And soon we will have the world's largest cobalt stockpile. And the stock goes up. When cobalt goes up, it goes down. So we IPO'd at $9, it went to $13, it's now at $5. We're buying more, personally, even though we're the largest shareholder already, because we think that this blip in cobalt prices come off 35%. It got a little bit ahead of itself. And we think that's temporary because of the supply challenges of cobalt, and it will come back. But that's an easy way to play cobalt, and it's relatively liquid, so you can buy 1 million or 2 of stock, and if you want to trade out of it a month from now, you can. There's the liquidity. And that's my talk. Thanks.
Thank you so much, Mike.
No, thank you.
If everybody